DeFi Slate team.
What's up, y'all? Real quick, if you like the DeFi Slate content on Twitter and YouTube and Substack, please give us a like and a subscribe on this video on YouTube. Join our channel, join the community. We'd really appreciate it. We're pumping this stuff out for y'all as much as we can, and we really enjoy the support and the community that we've built. Thank you very much and enjoy. What's going on, guys? Welcome to episode 42 of the DeFi by Design podcast. Here today with Rick from 𝗶𝗵𝗴𝗵 and, of course, Robbie, my co-host. And we're here to talk about DeFi and creating a professional and new DeFi 2.0 upgrade, if you will, right? So we're kind of excited to step into what people have been saying as DeFi Summer 2.0, but what we're kind of establishing in our framework as the next steps for taking DeFi mainstream and really making it so that those who are invested in 401ks or institutions or just the common mom and pop who are used to having insured, common, and practical use cases for their finances, you know, that they are used to, right? And that they can get adjusted to in the easiest way possible. So it's kind of a mouthful there, but we are excited to talk to Rick today. I'll pass it over to Robbie and get us started.
Yeah, man. Yep. So super happy to be talking to Rick today about 𝗶𝗵𝗴𝗵. And you know, they're pre-launch, so no one has really gotten a chance to interact with the technology yet, aside from the core team. But the vision is certainly there. The way I think about 𝗶𝗵𝗴𝗵, at least on its surface level, you know, the first DeFi summer, we had all these raw materials, all these raw tools that gave us access to DeFi, but it wasn't very intuitive, and they were all, you know, pretty segmented. They are composable, which is great to see, but they weren't engaged, they weren't integrated just yet. And I think that's where 𝗶𝗵𝗴𝗵 comes in and starts to build some of those structured products, take those raw materials and compile them into a more attractive DeFi offer that's more intuitive and more attractive for a large spectrum of investors. So I will go ahead and pass it off to Rick and let him introduce himself as well as 𝗶𝗵𝗴𝗵.
Yeah, absolutely. Thanks, guys. Well, first, I think you hit the nail on your head about, you know, what DeFi Summer represented, kind of where everything's been going for the last. I think everyone is really, when they say DeFi Summer, they're really holding on to just the last year. And DeFi's been building much longer than that. I don't think a lot of people do entirely realize that. For example, Compound has been around a lot longer than you know, the last 12 months, and that's just one example of that it has been coming. The mainstream is coming, and that's where, you know, I think why you know, me, you know, Mason, Noah, Sammy, we all really put our heads together and saw kind of the current ecosystem, the atmosphere, what's working, what's not, and why we started to, you know, decided to start 𝗶𝗵𝗴𝗵. And, you know, the whole joke, or the whole, like, why 𝗶𝗵𝗴𝗵, right? It's supposed to be that O with that exclamation, like, oh, like, I get it now. I really understand, like, this is what I've been missing. And we, you know, we started our little social push, right, around the whole, like, banks are giving you nothing. And that's the most mainstream you can possibly get, right? I don't know if you guys have Bank of America, Chase, you know, whoever, and you look at your savings account and you're what you're getting is probably something comical, 0.1% APR, maybe less, maybe more, if it's, you know, if you're playing stocks or you're playing, you know, if you're playing mutual funds. I mean, there's obviously some higher gains, real estate. There's some more traditional means to get, you know, earn money on your money. But when you cut all the middlemen out and you really give, you know, power to the people and, you know, power to the platform, you'll see that those gains are pretty tremendous. And that's what DeFi unlocks, and where, you know, we're really passionate about it. And that's where DeFi starts. And then that's now where it grows from there, is that whole O mantra of making it simple. You know, I can name all the platforms, our competitors, our lending tools that we leverage. And a lot of them, you know, I use them. I use every one of them. I've also been in crypto pretty deep, going on almost a decade now. And so, you know, trying to teach, say, my uncle how to use MetaMask is a challenge to me or you or to anybody, probably a lot of your listeners. It's you just click on, you go up to the puzzle piece in the corner of Firefox, and you click on your MetaMask, or you do it on your mobile, and you just do this, and it's easy. If I literally told that to my uncle, he would give up after one step, and that'd be it. And he's that's just one example of somebody we're trying to reach. So how do you bring DeFi mainstream? And that's, again, it starts with a really, really easy to use interface. It starts with, bot logic and bot framework that welcomes you to the site. For the people that haven't used or touched a wallet before, how do you get them to install it? How do you get them to understand it? Again, it's intended to be welcoming and easy, so that way anybody from the degen to the newbie is able to get installed, go get their USDC from wherever they want to get it from, and onboard it into DeFi and have their money start earning. And then, now we go from there. So now you're talking your curves, your AOVs, your compounds. All those sites have different levels of difficulty, different APRs, different levels of familiarity. What if you just had a giant button? At the end of the day, when you go to your bank and you put money in your bank and it just earns, I mean, it's earning nothing, but it's earning, and it's easy, it's familiar, but it's outside of that, it's not doing anything special for you. And that's, again, where O is going to differ, is that it is truly intended to be a single click, action to stake your money, stake your USDC, and start earning pretty tremendous APR on it, so that your money is doing more. So now that your DeFi dollar is doing more, how do you bring it more mainstream at that point? How do you convince somebody that, again, might try to take their 401k money and take some risk with it, right? DeFi, that's scary, right? DeFi's, you've heard all the rug pulls, and you've heard all the exploits, and all the exploits that were on BSC, or maybe the Titan collapse, when the peg was lost. You hear about all these things, and for the layperson coming in, it's terrifying. They're not gonna take their hard-earned, decades earned 401k and put it into DeFi. Well, that's where it then starts with multiple, contract audits. We have 𝗵𝗶𝗶𝗵 and 𝗵𝗵𝗃, two of the top known, and you have to educate people and understand them, like why these are the best, what they've looked for, why our platform's protected. Okay, you've now hit what every other yield aggregator does. A top tier yield aggregator isn't touching anything if you're not getting top tier audits. So how do you then differentiate one step further? And it's that insurance offering that we think is going to be truly special. And that's through Bridge Mutual, where it'll be a single click option, where when you vault your money, you have the option to insure your staking amount. And that's, again, the APR should outpace any of that fee, as well as outpace just leaving your money in, say, a 401k or leaving it in a bank. While giving you that peace of mind where, should the worst happen, you're sleeping soundly at night.
Right. Yeah, I think insurance is going to be huge for all DeFi users over the coming years. During the DeFi summer, as we say, I don't think really anybody used it, to be honest. It was just kind of this new concept. But I think as we grow to these people that you mentioned, right, it's going to start to become something that's more prevalent. Now, speaking of the APYs and APRs that banks offer compared to DeFi, I mean, a few months ago, it was absolutely nuts, the comparison. I mean, DeFi had 10x or more just on simple Aave pools or simple curve, right? We've seen yields collapse. Yields are now 3, 4, 5, 6%. You can get 10, 12, 18%, right? But you're pushing some sort of counterparty risk, whether it's Tether or a newer protocol or something of that sort. So how do you feel currently about the yields collapsing in DeFi, and what do you think about the next few months of yields in DeFi?
Yeah, so great questions. And I'll touch on all kinds of different pieces there. So with obviously the counterparty risks, that's the number one reason we're going with USDC. We will enable other stable coins down the road. There's no reason we can't do USDT and DAI. I think we all know USDT's history and its questionable collateralization, and also just the mechanics behind DAI that inherently provide more risk. So with that said, USDC is going to be available in probably every exchange everywhere, rapidly and quickly. It's already, and blockchains more importantly, it was recently announced for Avalanche, for example. Obviously, it's all over Polygon, it's all over Phantom, so it's everywhere. It seems to be, and it has the metrics to back it up, the most true collateralized stablecoin. As opposed to USDT, again, where there's a lot of questions behind it. So again, that brings that truth. $1 equals $1. That's got to be important because your asset that you have, if it's in a vault, should come out that asset. Again, that's all that trust, that security aspect. So that's really one aspect. Now, the yields. And that's a great point that you touch on because, for example, Coinbase launched their savings account, was it yesterday, I believe, or 2 days ago, 4% APR. That's not bad. That's nothing. Sorry, dog's coming in. So that's a good APR. It's way better than a bank, and it's also backed by a Nasdaq traded company, and you name it. So yields are crabbing. They're crabbing because lending's less, right? At the end of the day, what generates yield on a stable coin? It's gonna be your lending and your borrowing. So as the market is shooting up or the market is shooting down, people need to cover their longs and people need to cover their shorts. And that's ultimately where you're seeing all that lending action, which is generating yield. During, say, an extended bear market, where you're going to see a little bit more crabbing, a little less longing, a little less shorting, you're going to see those yields drop. So that's actually one of the things that I was doing differently, is by creating that DeFi index and having all the different protocols, but balancing between the protocols. What you're seeing is that you'll catch spikes a little better, and you can actually basically create a little bit of arbitrage between the APRs. It'll help kind of raise that floor a little bit in the APRs. So that's just one of the things that I was doing differently, is kind of that DeFi index that will help kind of separate us and raise that APR. In terms of the broader market, there's just some truths too. That the APRs will be lower. They're still going to be better than your bank. They're going to be better than BlockFi. They're going to be better than, pretty much any other DeFi-like product, Nexo, Coinbase. They'll just be less. And at the end of the day, though, doing a lot of market research, talking with the aunts and the uncles, with native token emissions, protocol fees, anywhere north of 6 to 10%. Is a great return. And then if the market starts heating up again, and you start, right. Yeah. Right. So I mean, it's not. I think we've gotten so conditioned that 6 or 8 or 10% isn't high enough. It's and low. That's I'm not gonna lie. I was all over iron. I got out at the right time, and I was making 2% a day or whatever it was. It was something insane. It was the highest of highs to the lowest of lows, and you get that degen addiction, right? You're like, I don't want to make 0.01% a day. That's nothing. Well, that's safe money. That's true savings. That's how you grow your wealth. And so I think that it starts with a mindset shift. When you're going to go, if DeFi is going to go mainstream, it can't be that I need to have 20%. In good times, sure. And that's the best part about DeFi, is I don't have to go to management and say, we're going to raise our rates today because the market's more favorable. The market shifts every day, which means that if Curve is more profitable, or Matic is running Matic Summer and giving Matic rewards, and we can reward our users with that, right? That money goes right back to the platform. And that's where, again, it's more of a mantra shift, is that once you start understanding, before we kicked off the show, before we were even talking about trying to play, when Bitcoin's is crabbing and how to trade it. And if you're not, really great at trading, it's a very hard range to play. So why try and trade it? So it's no different than if you aren't sure the right trade to make, and you aren't sure where to park your money, and you have a bunch of stable and it's just sitting there, go make money on it and be safe and secure doing it and be insured doing it. So every night you go to bed, you're still going to earn your interest. You're going to wake up tomorrow with more money than you had today. And I think it really, really starts with a whole a mindset shift. And that's as DeFi goes mainstream, you're going to start to see that. Yeah.
It certainly, you call it crabbing, and I've called it chop or range markets, whatever you want to call it. When Bitcoin and the major coins are in these oscillating, ranging, choppy kinds of markets, it just doesn't make sense to trade, especially on leverage. If your liquidation is anywhere close to the current price, it's very likely that you'll be liquidated. So Andy and I like to refer to that as almost you switch to survival mode at that point, and you just live to trade another day. Maybe that means you hold some spot, but ultimately you're not trying to time the market. And if the market does look quite a bit risky, then the safest play is going to be to hold stable coins and ultimately to still earn some yield on those stable coins. I think it is going to be interesting, now that Bitcoin has lost a lot of volatility, right? Because I think it really is not so much dependent on bull or bear when it comes to lending rates. It's really on volatility. If the market is clearly trending down, there's going to be plenty of shorters, and yields on Bitcoin and Ethereum are going to be, really high. Stablecoin yields being very low. So, the volatility and the bull and the bear, that all kind of evens out as time goes on. But an argument that I've heard Vitalik refer to is, in the long run, it's inevitable that DeFi rates ultimately collapse into kind of the rates that we're seeing in banks so far. And I think that's true to a certain extent. As more liquidity comes in, volatility is decreased, but there is still a margin that is captured by peer-to-peer lending and removing middlemen. And I'm kind of curious, in the long run, maybe we're looking 20, 30, 50 years down the line, it is inevitable that these rates are going to recede a bit. And as liquidity mining slows down, where do you think we end up? There's clearly a margin of surpassing the rates that banks can offer in the long run. But how much is that middleman worth?
Yeah.
And when we can provide that profit margin that a middleman is capturing now, once we can provide that to the entire community, what does that rate look like at that point?
That's a damn good question. Well, first off, banks, right? Let's just talk bank profits. Almost 70, it's 68 to 71%, depending on the bank you're looking at, of their profits go to management and above. So if you just took all that profit and put it elsewhere, that's DeFi. So that's just, if you're talking just pure potential, right? That's if you start pulling, if it goes true mainstream, we're talking 10, 20, 30 years, and banks, like we're talking serious money pours in the DeFi more than today. And you start trading equities and you start trading currency pairs more than just stable coins, right? You can kind of see where the DeFi narrative can go the more mainstream it goes. And that, therefore maybe the single asset APR comes down, but you're getting so much more volume that you're making those pennies over and over and over again. So the APR actually ticks higher. So that's one aspect of it. And then just purely, where does the equilibrium lie at that point though? If I'm guessing, I think you're going to start to see a pretty standard rate of like 4 to 5%. Mostly because I think that's where the middlemen and how much the banks are raking in, and just we've done a ton of research on where about that rate lies. I think it's probably closer to 4. I'm actually thinking that might be why Coinbase has kind of set their number at that. But you're going to see, that Coinbase rate, you're going to see that come down too. I would be shocked to see that hold it at 4% over time, just because again they have investors and above that they have to pay. So At the end of the day, it's either power to the people, giving back to the people, or it's giving back to something higher. And that's just the truth of it. So that is the power of, if you cut out all middlemen and you give it all back to your community, that's what you get. So I maybe it's way higher. I guess if Bitcoin is truly the appreciating asset that we all say it'll be, and 100,000's a meme and a million's a meme and Ethereum to 10,000's programmed, that 4 or 5%, honestly might be meme, because you're going to see a lot of chop between the next 10 years as those numbers get realized, as inflation goes and as those happen. So yeah, 5% in 20 years, sure, but you're probably going to have a lot of years between now and then where you're getting 10, 12%, per annum constantly, and that's going to be exciting times to be a part of and to be early on, and to have not parked your money in a bank.
Right. And I think mainstream kind of sees high APYs like this and gets excited. 4% isn't anything crazy. So maybe that doesn't raise a skepticism for somebody who's just immediately thinking, oh, this has got to be a Ponzi or something, right? But when we start to think about 12, 20%, 15%, starts to raise red flags for anybody who's ever existed in the financial world up to this point, because it's like, well, everything that I've ever experienced in my life that is like this has just not lasted and has just been a
Yep.
total sham. So my question to you, Rick, is how do we provide the front ends, right? So we know what the back end is. We know that the back end is Curve, it's Aave, it's Compound, it's 𝗷 it's all these protocols that are basically just combining and stacking these protocols on top of each other to earn yield, kind of like this, the concept of the Legos. But how do we get the front end so able to be onboarding to so many users? Because frankly, people see 8%, they're ready to throw their money at it. They don't particularly care what's going on in the back end. They want to know what's going on. And the answer is, well, you know, you're putting your money in this protocol, and then you're taking those interest-bearing tokens and maybe here. And, you know, if you want to go even a little further, you can go here, right? So, you know, maybe there's like 3 buckets of risk, kind of how advisors do it, right? But you know, the question is, how do we take Aave, Compound, and all these other protocols that DeFi has to offer and bring them to mainstream in the UI of a front end that's, you know, equivalent to that of Coinbase or that of TD Ameritrade or that of an app on your phone? Like, what does that look like?
Kind of twofold, if you ask me. It starts with, again, simple. A lot of the DeFi apps are too hard. MetaMask is too hard. So, I mean, there's going to be, I'm not going to pretend like we can make MetaMask invisible. It can't happen at this time. It just runs, you know, and then not just the Trust wallet. I mean, you know, name your wallet of choice. They run the space right now. It's just the truth. And so, you know, it starts with education for now, to how to onboard people and get them familiar with it, and then trying to just minimize clicks, read your EIPs, and switch things to signing steps, so you're not having to wait for an approval action to go through, and then also confirm on the blockchain. Starts with using new blockchains that are quicker and easier. You know, if you look at the Avalanche blockchain, right, which is made for basically financial security, you know, identifying those opportunities early where transactions complete really fast and really cheap. So that way, for an end user, when you click and it comes right back, it's a lot more of something you would expect. I click deposit, I get a confirmation that hits back in a second. That's more what you're used to when you go and make a trade on Coinbase or do something with you know, Fidelity. And that's just the truth of the current world. And now the more broad world is, how do you integrate on-ramps, fiat on-ramps, USDC on-ramps, you know, to directly into your site. So, I mean, ultimately where O would love to go is to have a true USDC on-ramp, like you know, attach your bank account and say, I want USDC, and it gets onboarded into the system. And then you have like a native wallet or a single
mobile app,
button.
or are you thinking only desktop?
Mobile app's the dream, right? That's also the hardest piece, right? Everything has to run through a dApp browser right now. And that's just, again, the truth. Anybody that's promising otherwise is, it's hard. It's just not how smart contracts work. It's not how the dApps work at this time. So, you know, we're gonna have some bumps on that road, but you know, you've nailed it though. Having an app on your phone where 2 clicks and you deposit, not having to go through even the MetaMask browser, for example, like that's the future. And they're getting there. I mean, there's integrators working there. There's blockchains looking to make that easier.
Yeah, y'all should check out the CeeLo chain. It's been around for a while. I remember they listed on Coinbase and nobody knew why, like 3, 4, 5 months ago. Today's July 1st. Happy Canada Day. And and it pumped like 250%. Everyone's like, what the hell happened? And then now they're basically full out trying to build DeFi for mobile. That's their only USP. Like, we're gonna build DeFi on mobile. So for everyone listening, and you know, I encourage y'all to check it out as well. It's pretty interesting.
I will warn you, we're having a vicious thunderstorm. So if I just disappear, that's what happened, guys.
Gotcha. Yeah, Rick, you hit on some of the important UI features that I think will help bring DeFi to the masses. Takeaways there being minimize clicks, right? Like, people just don't want to click. Clearly, high transaction speeds is critical for both mainstream and institutional. Institutional can deal with those high fees that usually come with faster transactions, but everyone wants those fast transactions so that you're not left stressed and waiting for a confirmation. And just, one big button. So don't make it, very complicated. Like,
what do you care about? You care about a big button, how much yield, how much have you made to date? What are your fees? That's like, everything's been overthought. Like, what's important to you?
When you look at Curve, right, and it looks like an airport terminal, and it's like, how do I even navigate this thing? It's overwhelming, right?
For 3 dashes in the left corner, click your pool, maybe hit withdrawal, maybe hit deposit, get lost in the statistics.
yeah. So there's a really intuitive design here that's coming to 𝗨finance. My question is, and you touched on this a little bit when you start getting into Avalanche, CeeLo, and more target specific blockchains. My question really is on the strategy side of things. You want to provide your customers with a certain level of return, and I guess you're comfortable with taking on some risk to do that, right? And the insurance level is just another layer to mitigate that risk. What did you and your team take into account when you looked at the protocols that are out there, and you thought to yourself, okay, we're going to start to bring structured products to DeFi. How do we want to build these projects? How do we want to build these products, and what kinds of applications are involved in each one of these strategies?
That's just, it's the trusted ones for now. I mean, even, at launch, for example, like, our 𝗵 strategy won't be at launch. And, 𝗵's a very strong protocol, has higher yields than most. It also has a little bit of risk. And at launch, we want you can never promise in DeFi, especially, you can't say zero risk. If you are, you're lying. That's why we have insurance offerings and smart contract audits and do everything you can. But it's a new world, and that's the hardest education piece again, is what risk are you willing to accept? And that's where, by going with Curve, and that's Uniswap LPs, SushiSwap LPs, Compound, like Tried and Balancer, like as you go with tried and true, and that's where again the multi-chain story is going to get popular, but for reasons I don't think people have thought of. It's more that every chain that's lighting up and will continue to light up for the next 5 years is going to offer rewards in their native tokens. Do you care that reward's in Matic? Do you care that it's in Phantom or AVAX or Near protocol? No. You just care what your APR is. So if you can hop around those chains, invisible to the front end, right? So when you stake your USDC and that USDC is able to take advantage of those other chains and thus kind of maximize that APR, that's going to be really unique. And that's, again, something else where, it's more of a roadmap item as we're looking at our other chains and what they offer. It's going to be a lot of that, using the tried and true protocols, but using it to maximize the on-chain rewards and the advantages and disadvantages of each of those chains.
Right.
And I don't want to.
And that's more that's even more degen than I thought I'd even get into. But again, it's making it invisible. I don't want that layer. That layer will not be visible to, like, again, I always use my uncle as an example. If I go, hey, we got this cool blockchain called Avalanche or this cool one called Binance Smart Chain, he's gonna be like, no. I got this tweet that said something about MetaMask and I have to install it and get Ethereum. What's Ethereum? And that's the level, like, that's the education level, like, a high-ish net worth individual that it's going to take me an hour to teach him DeFi. And that's, you got to get that to a minute, probably less, or you've lost his interest, you've lost his risk appetite, and he'll go somewhere else.
Yeah. And that is one of the pillars of our mission, is to educate, the masses and just make them more comfortable so that as new technologies are developed, it becomes innovative and it's just accepted, right? It doesn't take a lot of thought process and judgment really just to like dissect it too deep, because once you do it once and it hits that moment and it clicks, then everything kind of falls into place afterwards, which is super cool to see. So I'm interested kind of as a degen myself, right? Because we're trying to attract the masses here to the product, but it's important to just, I guess, work through the different layers of each of these projects, especially while we're early. And I'm curious, kind of from your experience of developing these strategies in the back end, right? You're rehypothecating funds by collateralizing in one place, borrowing, taking that borrow, putting it in another place, and so on and so forth. Lots of incentive mining is going on. Ultimately, I think it's pretty well understood. This is kind of creating money out of thin air. How long can this go on? Is it a detriment to the space, or is it ultimately adding value and growing the sum of wealth here that we can all share?
So it depends on money out of thin air in my mind. And trust me, I get that sentiment is more the true Ponzi's, where they're built to inflate. There's just never ending inflation. And the people that get in early, do the best. And the people that get in late are ruined. That's anything. If you buy a stock at the top and then it's the stock market pops, that's not buying. That's not, I guess, you could argue the stock market, right, is a giant Ponzi at its very, at its very core. Those in early do the best, those in late do the worst. But it's not creating money out of thin air. And I'll push back on that. And I'll say the reason being is, of course, what's powering true DeFi, lending and borrowing. What powers the stock market? What powers banks? What powers interest rates? Lending and borrowing. There will always be lenders and borrowers, people, betting on a direction of something, whether it be Bitcoin, Ethereum, pick one of the other high liquidity pairs, pick stonks as we start, mirroring Tesla and other things into crypto, and people start leveraging the bets on those. Like this, where DeFi is going, there's always going to be people betting. That's just our society. Which means you're going to be those interest rates. If you're willing to loan money to let somebody else go make a bet, you're gonna get rewarded in that. So will capital be lost? Absolutely. Will capital be gained? Absolutely. But that's been, I guess you could argue inflation. Isn't that why we're in, a trillions of dollars of debt? Just more generically speaking, sure. Is people getting liquidated going to create more debt? Absolutely. But I think to the smarter investor and to the understanding how it actually works, and to what protocols will do well in DeFi and what will exist, I think that's where more understanding how they work and how you can grow together will do okay.
Yeah, that piece seems to fit the puzzle well. I think a lot of newcomers to the space, especially when APIs are through the roof, they see that as free money almost, and it seems like it's being printed out of thin air because you can't really identify a source. It's like, where is this coming from?
Free internet money.
right. Magic internet coins, right? But yeah. your answer specified like, no, this is really coming from the lending and borrowing. By making that a more seamless and efficient process, there's value created, right? So let's take Polygon, for example. Polygon wants to encourage lending and borrowing. Like you said, anyone wants to bet on something. They're betting on one way or another. And if you can nudge people in a certain direction to take a bet and they'll pay you for that, then yeah, right. It's simply an arbitrage trade at that point. Like, yeah, you want to encourage me to take this bet. I hear you. I see you. I'll take that bet, and I'll take your free internet money too. And then I'll hedge my risk elsewhere and maybe I'll amplify it, if the market's trending and whatnot. But ultimately, yeah, it is stemming from a source, right? It's not just coming out of thin air, which I think is just a hurdle to get over it if you're brand new to the space.
Yep.
Yeah.
And don't chase the don't chase the, I guess my recommendation is be careful. If you see a massive APR, the degen in me will chase them. Don't get me wrong. But if you're new to the space, understand, what is DYOR? Do your own research. Know what you're investing in.
But the craziest part is normal people see, the 12% as crazy high. So
and they should. That's fine.
Right.
Like the sooner the space understands that, like if you could tell me everything I made from a bull run, I park and make 10%, you should be so happy that you should be literally laughing. But like we've been so conditioned, especially the degens in us, that like, when you hop into a launch and it's a little bearish right now when things aren't 10xing, and you didn't 2x, you're holding for that 2x. You're like, man, I'm not selling, and then it goes down 99%. Like I should have sold at 1.8x.
Yeah, in a day, it's 2x in a day. It's not like
2x in 15 minutes. And and it's an addiction a little bit in that regard.
Give me
and that's
those
where
market conditions back. Jesus Christ, man. Man.
And that's where 10%, especially on stables, like anything in that ballpark, you should be, shut up and, where's the fry picture? Shut up and take my money. And it's the sooner we get that mindset shifted is the sooner like banks start, people, they stop like villainizing DeFi.
Yes.
Yeah.
That's when the bottom of DeFi hits, is when people are just all satisfied with their stablecoin yields, and then everything just starts getting deaded up again and ripping. I'm not sure that we ever see those market conditions again that we saw the last 8 months. Everyone was cramped up in their houses during COVID, all the fear of inflation, and everyone's just gambling their life away, trying to hit it big, buy a house and secure their family's name, prior to the world collapsing. And then all of a sudden the world didn't collapse. Everything's fine. We're all fine. But those conditions were just ripe for pure speculation. And I think it was on
2017's calling and disagrees, however. So
right,
point
exactly.
I'm making is you'd be surprised that there will be another cycle, and you're going to be saying this in 3 or 5 years from now and be like, I didn't see that coming at all.
Yeah. I think the theory of diminishing returns is certainly applicable to Bitcoin.
And the concentric circles where it's always a little less.
Yeah. And perhaps Ethereum and such, but there's always going to be more tokens. Rick, I'm curious, what do you think about how many tokens there are out there now? Like, what do you think about 8,000, 10,000 tokens? Like, what's your thought?
Too many?
Process? Yeah.
Too many. I mean, it's money to be made. I mean, it's a market where if you are technical and you know what you're doing and you can put together a decent white paper, I was joking before this call. I came on and bought 20 cats, really fun NFTs. It's a space where there's money to be made. And as a result, there's going to be a lot of scams. There's going to be a lot of, tokens that add no value. Tokens that are just created by somebody with no intent to ever build or grow or understand, what you're doing. And also that's the whole, and more just like, it's also that DeFi mindset of like, I didn't 2X. Like, when you buy a stock, say you bought Microsoft in 88, or I'm aging myself, but if you buy something, you should think to hold it. And at this point, crypto is not really, other than Bitcoin, Ethereum, Litecoin, Dogecoin, you don't think to hold it for a long time. And if the protocol's built right and the fees that it's generating are doing what they're supposed to do, the token should appreciate. So, I mean, this is going to be callous, but how many communities do you come in and be like yelling at the developers, like when marketing, when this, when, and the protocol is what does it. The code does it. The contracts do it. So if you actually, but they didn't get their 1 month gain, so you are a scam. No,
so you're in trouble.
I mean, look at Celsius, look at Nexo, look at how their tokens have appreciated over the course of a period of time. A multi-100% return in 5 years should have you ecstatic on your token too. But that's the whole mindset is, and again, I'm right there with the crowd. When marketing, I go into my communities and say, like, when are you going to market? I'm sitting on your bag. But it's the truth. Like, if you when
are you guys going to have like a DAO and a governance structure?
Yes, 100%. It's very, very core to who we are. At the end of the day, you build the protocol, you hand the protocol off.
And that's kind of crucial to like the legality as well, especially in the States.
Yeah, it's welcome to launching a token in being obviously if you follow me on Twitter or anywhere, I'm based in the US. There's just rules that you have to abide by, very strict. And that's just the truth. It's just what it is. Hopefully there's not, I mean, even the guidance, you're really just doing your best to truly, we had and kind of a lot, or at least more just not even relaxation, just more guidance. I mean, if you are a developer, you're a token launcher and you want to do this and feel like you're not gonna have somebody knock on your door tomorrow, honestly, it's hard.
Yeah, but like, what is the SEC even doing?
And DAO is one aspect of it. Right now, I mean, they're unclear. I'll tell you that. Very truthfully, if you're small enough, they leave you alone. I guess if you're big enough, they hit you with a fine. If they can catch you on the, there's a couple different tests that your token has to pass as to whether the whole security or not. And
What
again,
do you
it's
think
why you
about
hire
the
good
Ripple?
lawyers. And
Sorry, what do you think about the XRP case right now? If you know anything
what
about
is
it.
the latest on XRP? Basically banned in America, right? For the most part, still
Yeah.
kind of flourishing international. Again, it's my opinion that America's being heavy-handed. I think. With that said, I mean, I do think there's truth to the lack of regulation leading to both unclear rules, but also rug pulls. People can create with no fear.
Yeah.
And it's part of why we doxed for this and we want to own this, is that if you're building with the intent to build something good, because you're trying to be a technologist, and that's just, again, that's just the truth. And back to the Ripple piece, I from the what I've read, yeah, there was a lot of promises dumping. It's a shady case. I mean, I'll tell you that. I mean, if you actually read into like what the Ripple organization did and promises that were made, as well as insider trading, I mean, there's a lot of things that you can do in crypto that you can't do anywhere else. And so that's pieces where people are like, that he just said they should regulate, and I'm gonna hit him with a bunch of hate on his Twitter.
Yeah.
I also don't like going to buy a token that's probably going to rug. And I guess people are going to be like, you're in charge of your own investment. Sure. But like, there should be some fear. Like, you shouldn't be able to just steal millions of dollars and have no repercussion or no risk.
Uniswap has totally enabled, the creation of new liquidity pools. Just pair a token with ETH and you're good to go. I mean, we've seen more just stuff than ever before. It's nonetheless very interesting at its core, and we're excited to see how Finance kind of builds through, takes DeFi to the mainstream, and keep pushing forward on that vision. That's definitely something that we have aligned here. So yeah, Rick, thank you so much for coming on, man. It was an absolute pleasure. Closing thoughts. We're excited to hear about launch and get more info out there.
Great. Thanks, guys. It was a great time.
Yeah, appreciate it, Rick. Thanks for coming on. Super excited to see what Finance has put out there. And yeah, just let us know how we can get involved and get our community involved.
Absolutely. When launch, right?
When token, sir.
When token, sure.
Hopefully middle to end of this month.
All righty.